What if I told you that every major recession in American history had clear warning signs and that most people completely ignored them? From the Great Depression to the 2008 financial crisis, from the dot-com bubble to the 2020 pandemic shock, there's a pattern that repeats itself again and again. Today, we're going to break down the exact warning signs that predicted every major economic downturn, and more importantly, we're going to show you what they mean right now. Throughout history, recessions don't just happen overnight. They're the inevitable result of imbalances that build up in the economy over years. Think of it like a building with a cracked foundation. You can ignore it for a while. The building might still look fine on the outside, but eventually that damage catches up with you. The question isn't whether a recession will happen. History proves it will. The question is, can we see it coming? And the answer is absolutely, but only if we know what to look for. A recession is defined as 2 consecutive quarters of negative GDP growth, which is economic contraction. But before that official declaration comes, there are several warning signs that appear months, sometimes even years in advance. Understanding these signals is crucial because it allows you to prepare, make smarter financial decisions, and protect yourself from the inevitable downturns that are part of our economic cycle. Let's start with the most famous warning sign that has proven to be one of the most reliable recession predictors in history: the yield curve inversion. When you lend money to the government, they pay you interest, but the amount of interest depends on how long you lend them the money. Normally, if you lend for 30 years, you get paid more interest than if you lend for just 2 years. That makes sense, right? You're taking on more risk by lending long-term, so you deserve higher compensation. This creates a normal yield curve that slopes upward. But here's what's strange and fascinating. Sometimes the short-term interest rates get higher than the long-term rates. Investors would rather get paid less to lend for 30 years than get paid more to lend for just 2 years. This only happens when people are terrified about the near future. They're so scared of what's coming in the next few years that they'll accept lower returns just to lock in safe, long-term bonds and protect their capital. When this happens, we call it a yield curve inversion, and it's been one of the most reliable recession predictors in history. Let's look at the evidence. Before the 2007 to 2008 financial crisis, which was the worst recession since the Great Depression, the yield curve inverted in 2006. The recession started in December 2007. Before the 2001 recession, the yield curve inverted in 2000. The recession started in March 2001. Before the 1990 to 1991 recession, the yield curve inverted in 1989, and the recession started in July 1990. Before the 1980 to 1982 recessions, the yield curve inverted multiple times in the late 1970s, preceding multiple recessions in the early 1980s. The pattern is undeniable and consistent across decades. But here's what's interesting. Most Americans don't pay attention to the yield curve. It's considered too technical, too boring, too inside baseball. So while economists were sounding the alarm, writing papers, and issuing warnings, everyday Americans kept spending, kept borrowing, kept taking on debt, and kept acting like nothing was wrong. And then, when the recession hit and unemployment soared and people lost their homes and their retirement savings were decimated, people acted shocked. How could this happen, they'd ask. But it was predictable. It was predicted. People just weren't paying attention. Our second major warning sign is perhaps more intuitive and easier to understand: rising unemployment and jobless claims. When people start losing their jobs or when companies start laying off workers, it's a clear signal that the economy is weakening. But here's the key thing to understand. It doesn't happen suddenly. It follows a specific pattern. First, you see jobless claims start to rise. These are new people filing for unemployment benefits each week. It starts slow, then accelerates as the economic weakness spreads. Then you see the unemployment rate itself start to climb, as the cumulative effect of all those layoffs adds up. The important thing to note is that this usually lags behind the actual recession. The economy might already be in a recession before unemployment really starts spiking. This is because companies are often slow to lay people off. They try to hold on to workers, cut hours, freeze hiring, reduce bonuses, before they resort to actual layoffs. By the time the unemployment rate is obviously rising, The recession is already underway, and companies are in crisis mode. Let's look at the specific numbers from history. Before and during the 2007 to 2008 financial crisis, which was the worst recession since the Great Depression, the unemployment rate went from 5% to nearly 10% by 2008. The recession was already months old by the time most people realized it was actually happening. More than 3 million jobs were lost during this recession, and it took years for employment to recover. During the 2001 recession, initial jobless claims jumped from around 300,000 to 400,000 per week during the recession period. Employment continued falling for over a year after the official economic contraction ends, showing how long the labor market pain persists after the official economic contraction. Before the 1990 to 1991 recession, unemployment rose from 5.2% to 7.8%, but this increase happened gradually over many months, giving people who were paying attention time to see it coming and make adjustments. During the 2020 pandemic shock, which was different from a traditional recession because it was caused by an external event rather than internal economic breakdown, jobless claims went from 200,000 per week to 6,800 per week in just 2 weeks. It was the fastest labor market collapse in history, but even then, people didn't see it coming because the shock was external and sudden. Here's what's important to understand. People often ignore rising unemployment rates because they personally might still have a job. If unemployment goes from 4% to 5%, that doesn't sound dramatic to someone who is still employed, but it means millions of people just lost work and are struggling financially. We have a tendency to think it won't happen to me until it does, and then it's too late to prepare. The third major warning sign is about stock market valuations and how they become disconnected from reality. This is where investors get excited and bid up prices based on hope and speculation, rather than fundamentals. Let's start with a basic concept, the price-to-earnings ratio, or PE ratio. This simply compares the price of a company's stock to its actual earnings. If a company is making $10 per share in profit and its stock costs $100, then its PE ratio is 10. A PE ratio of 10 means you're paying $10 for every $1 of annual earnings. Historically, that's considered reasonable. But sometimes investors get incredibly excited about future prospects, or they believe everyone else will keep buying. Or they suffer from herd mentality. They buy stocks based on hope and speculation, not based on actual current earnings. They think surely this company will be worth much more in the future. When this happens, PE ratios inflate dramatically, reaching levels that have no basis in reality. When you look at historical valuations, the average stock market PE ratio is around 15 to 17. When it goes above 20, we're in risky territory. When it goes above 25, we're in bubble territory, where prices have become completely disconnected from the value the companies are actually generating. Let's look at specific historical examples. During the dot-com bubble that peaked in 1999 to 2000, PE ratios for tech stocks soared above 100. Some companies with no profits whatsoever, companies that were burning through cash and had no clear path to profitability, had market values in the billions of dollars. Investors believed that simply being on the internet was enough to justify any valuation. The Nasdaq PE ratio reached 32, absurdly high. People were making money fast by flipping stocks, and everyone wanted in on the action. Then it crashed 78%. Billions were lost. People who had invested their retirement savings in tech stocks saw them drop to a fraction of their value. During the housing bubble that peaked in 2005 to 2007, housing prices detached completely from the fundamentals of income and rent values. A house that should have cost $300,000 based on what rent would justify was being sold for $500,000. People were buying properties as investments with no intention of living in them, believing that house prices could only go up. When this bubble burst, we got the Great Recession, the worst economic contraction since the Great Depression. Recently, during 2021 to 2022, tech stocks again reached extreme valuations. The Magnificent Seven tech stocks drove valuations higher than any time except the dot-com bubble. These were companies like Apple, Microsoft, Google, Amazon, Tesla, and others that had become so popular that investors would buy them almost regardless of price. When the Federal Reserve raised interest rates to fight inflation, these high valuations suddenly looked silly. If you can get 4% risk-free in a treasury bond, why would you pay 100 times earnings for a stock? The valuations crashed. Here's what happens when valuations are inflated. When valuations are inflated based on hope and speculation rather than fundamentals, any small problem causes a crash because the high valuation was based on optimism and hope, not fundamentals. The moment that optimism cracks, the whole thing collapses like a house of cards. And the warning sign is clear. When PE ratios get too high, when prices become disconnected from underlying value, be careful. Historically high valuations almost always mean a correction or crash is coming. Now we're getting to something really important that affects the entire economy: credit growth and debt accumulation. When the economy is overheating, when people feel wealthy and confident, credit growth accelerates dramatically. People borrow more and more money. Businesses borrow to expand. Banks get more and more reckless with their lending standards. On the surface, this looks great. The economy is booming, companies are expanding, people are buying houses and cars, construction is happening everywhere, everything looks prosperous and strong. But underneath, you're building an unsustainable debt structure that will inevitably collapse. Think about it this way. If everyone is borrowing money, someone has to pay it back, and they can only pay it back if they have income or if they can borrow more money. This creates a system that's dependent on continuous growth and rising incomes. The moment growth slows or incomes stop rising, the whole thing breaks because people can't service their debts anymore. They're stuck with payments they can't afford. Let's look at the historical evidence. Before the 2007 to 2008 crisis, total household debt doubled from 2000 to 2007, from $5 trillion to $10 trillion. Most of that was mortgage debt, much of it given to people with bad credit and minimal ability to repay. Subprime lending exploded. Credit card debt soared. Auto debt soared. Home equity loans were issued based on home values that everyone knew were overinflated. Banks were so eager to lend and earn fees that they gave mortgages to people who couldn't possibly pay them back. They gave ninja loans, no income, no job, or assets. Mortgages were given to people who couldn't even afford the initial payments, let alone the payments after rates adjusted upward. When housing prices stopped rising and people couldn't refinance, when interest rates adjusted upward and payments doubled, the whole thing collapsed. Millions of people found themselves owing more on their houses than they were worth. They couldn't refinance, they couldn't sell without losing money, and they couldn't afford the payments. Foreclosures exploded. The financial system nearly collapsed. Before the 2001 recession, corporate debt had soared in the 1990s as companies took on leverage and issued bonds to fund expansion. When the tech bubble burst and companies couldn't grow as expected, they couldn't service their debts. We saw mass layoffs and bankruptcies. Right now, in 2023 to 2024, total U.S. debt has soared to over $35 trillion. That's over 120% of GDP. Federal debt has nearly doubled in the last 10 years. Student loan debt has quadrupled since 2005. Credit card debt has hit all-time highs. People are borrowing against their cars, their homes, everything they own. The warning sign is clear. When debt growth outpaces income growth, when people are taking on more and more debt while their incomes stagnate, you're building a house of cards. Eventually, reality catches up. Here's another warning sign that's almost guaranteed to trigger a slowdown: rising interest rates. The Federal Reserve controls short-term interest rates, and when they raise rates, it gets more expensive to borrow money. In an economy built on borrowing, on cheap credit that allows people and companies to spend and invest more than they currently earn, higher rates are poison to growth. Let's understand why this happens. When borrowing costs go up, companies reduce expansion plans, new factories don't get built, new products don't get developed, companies invest less money. Mortgages get more expensive, so fewer people buy houses. Car loans get more expensive, so people delay car purchases. Credit cards get more expensive for those carrying balances.
Higher rates also make savings accounts and bonds more attractive compared to stocks, so money flows out of the stock market into safer investments. If rates rise too quickly, you can shock the economy into a recession. Let's look at historical examples. In 1980 to 1982, Fed Chairman Paul Volcker raised the Fed funds rate to 20% to fight inflation. It worked brilliantly at stopping inflation, but it also caused the worst recession since the Great Depression. Unemployment hit 10.8%, thousands of businesses failed, the housing market collapsed. But inflation was finally broken, and the long bull market of the 1980s followed. From 2000 to 2001, the Fed raised rates from 3% to 6.5% in 1999 to 2000 to slow the economy and prevent overheating. The dot-com bubble burst, and we got the 2001 recession. From 2006 to 2007, the Fed kept rates at 5.25% while the economy was still overheating from the housing bubble. This made subprime mortgages even more expensive, which is what triggered the housing crisis when ARM rates reset upward. In 2022 to 2023, the Fed raised rates from 0% to 4.25% in just 9 months to fight inflation. This caused a banking crisis as banks with long-duration bonds suddenly faced massive losses when rates rose. It sparked fears of recession and knocked down valuations across the economy. The warning sign is clear. Rapid rate increases often precede recessions. But here's what's interesting. Most people don't pay attention to Federal Reserve policy. They have no idea that interest rate decisions made in Washington, D.C. by the Federal Open Market Committee will affect their ability to get a mortgage, buy a car, or keep their job. They don't understand that when the Fed is aggressively raising rates, recession risk is rising too. So when rates rise and the economy slows, people are caught off guard, but it was predictable. Consumer spending accounts for about 70% of the U.S. economy, which means when consumers stop spending, the entire economy slows down dramatically. The warning sign comes in two forms. First, consumer confidence drops. People get worried about the future, so they cut back on spending. They stop buying the big things like houses and cars, and they even reduce spending on smaller things like dining out and entertainment. Second, savings rates change. When people get nervous about the economy and their jobs, they save more money and spend less. Conversely, when people are confident and feel wealthy, they spend more and save less. These metrics usually shift before the official recession begins, which makes them leading indicators that predict what's coming. Let's look at historical consumer confidence data. Before the 2007 to 2008 crisis, consumer confidence peaked in mid-2007, then started falling sharply. Spending slowed in late 2007. By the time the recession was officially declared in December 2007, people had already been cutting back spending for months. Retailers reported disappointing sales. Real estate agents couldn't sell homes. The slowdown was already happening in the real economy before economists officially called it a recession.
Before the 2001 recession, consumer confidence fell sharply starting in 2000. Retailers reported slower sales. People stopped buying cars and appliances. Then, the tech crash happened, and confidence collapsed even further. Before the 1990 recession, consumer confidence fell from 1989 into 1990. Spending on vehicles and homes dropped. The savings rate increased as people got nervous. During the 2020 pandemic, consumer confidence dropped 21 points in a single month. Spending collapsed, retail stores closed, restaurants shut down. But consumer confidence also recovered faster than expected once people realized they'd still have jobs and the government would send stimulus checks and enhanced unemployment benefits. Here's what's important to understand. Consumer confidence is somewhat self-fulfilling. If people believe the economy is going to be bad, they spend less. When they spend less, companies earn less revenue and lay off workers. When workers are laid off, even more people cut spending, so the belief becomes reality. The warning sign is, if you see consumer confidence dropping, especially if it's dropping fast, people are worried about something. And they're usually right to be worried, because their confidence is based on information and signals they're receiving about the economy. Finally,
let's talk about a collection of metrics that economists call leading economic indicators, or LEI. These are things that tend to change before the overall economy changes. They include new orders for consumer goods and capital goods, supplier delivery times, permits for new residential construction, stock market performance, interest rate spreads, consumer expectations about future business conditions, average hours worked in manufacturing, initial jobless claims, and several other metrics. The key point is that when most of these indicators are weakening at the same time, a recession is likely coming. Think of it like the human body. If your blood pressure is slightly high, you might be okay. But if your blood pressure is high, your heart rate is elevated, you're short of breath, you have chest pain, and you're sweating, you probably need to go to the hospital immediately. Similarly, if one or two economic indicators are weak, it might not mean much. It could just be temporary or isolated to one sector. But if several are weak simultaneously, all pointing in the same negative direction, it's a serious warning sign that something is wrong. Historically, every recession has been preceded by a significant weakening in the LEI composite index. They're not perfect predictors. There have been false signals where the LEI fell but a recession didn't follow, but they're more reliable than any single indicator on its own. When you combine them, when you see new orders falling, housing permits declining, stock prices falling, and consumer expectations dropping all at the same time, the probability of recession is very high. The warning is, when multiple indicators all start pointing in the same negative direction at the same time, it's serious and you should pay attention.
So what does this tell us about the current economic situation? Here's what we're seeing right now. Some warning signs are definitely present. The yield curve has been inverted since 2022, when the Federal Reserve started raising interest rates. That's a historically serious signal that has never failed to predict a recession eventually. Credit growth is slowing as rates have remained elevated and borrowing has become more expensive. Consumers are showing signs of stress, with credit card debt at all-time highs and delinquencies starting to rise. Savings rates are falling, which means people are dipping into their savings to maintain spending. But on the other hand, unemployment remains relatively low, which is unusual during a recession. Corporate earnings have held up better than expected, which suggests companies are still profitable. Some sectors like technology and energy have remained strong. This mixed picture suggests the economy might be running on fumes but hasn't crashed yet, or the recession has already started and we just haven't officially recognized it yet. The National Bureau of Economic Research, which is the official arbiter of recessions, often doesn't declare a recession until months after it's already started. Or strong corporate earnings and low unemployment might prevent a recession from happening at all. Some economists believe we could have a soft landing, where inflation is defeated and growth slows moderately without a recession. The honest truth is, we don't know for certain what will happen. No one does. Economists, Federal Reserve officials, Wall Street analysts, they all disagree and change their forecasts constantly. But what we do know is how to look for warning signs. We know which indicators have historically predicted recessions. We know the patterns that repeat again and again. And that knowledge is valuable, because if you understand these indicators, you can make smarter decisions about your own finances, your career, and your investments. You can prepare. You can position yourself to weather whatever comes next. You can keep your emergency funds stocked. You can avoid taking on excessive debt. You can diversify your investments. You can make sure your job skills are valuable and in demand. You can reduce your spending and build savings. You can pay attention to these warning signs and adjust your behavior accordingly. Here's what we've learned today. Every major recession has had warning signs: the yield curve inversion, rising unemployment, inflated valuations, excessive debt growth, rising interest rates, collapsing consumer confidence, and weakening leading economic indicators. These aren't random signals. They're patterns that repeat because human nature and economics don't change. The economy booms, optimism soars, people and companies take on excessive debt, prices become disconnected from reality, and then reality catches up. The overheated economy slows. Debt that seemed manageable becomes burdensome. Asset prices that seemed reasonable are revealed to be overvalued. The correction happens. The warning signs appear months, sometimes years before the crash, but most people ignore them because they're distracted, or they don't understand them, or they believe the pundits who say this time is different. But when the crash comes, they're devastated. They lose jobs, they lose homes, their retirement savings are decimated. If you understand these warning signs, you have an advantage. You can see what's coming when others don't. You can prepare, adjust, and protect yourself. You can make better decisions for yourself and your family. The question is, will you pay attention next time? Will you monitor these indicators? Will you understand what they mean? Or will you be like most Americans, going about your life, ignoring the warning signs, and then being shocked when the next recession hits? The choice is yours. The information is available. The pattern is clear. Now you know what to look for. What you do with that knowledge is up to you. Thanks for watching. If you found this video helpful and informative, please like, subscribe, and share it with others who want to understand the economy better. Leave a comment below with what you think the biggest warning sign for the future economy is, and let's discuss what might be coming. The economic cycles will continue, but if we understand them, we can navigate them more successfully.